Starts.
Yes, sir. Good evening, members. On behalf of the SARC of ICI, we welcome you for the standards on auditing on SA 250, SA 260, SA 265, and we have with us an eminent faculty, Mr. CA SK Jagadishan, BCom FCA. Jagadishan sir is a chartered accountant with nearly 10 years of experience at the audit department and is presently in practice for the last 4 years, advising and assisting clients in Ind AS transaction for companies that are adopting Ind AS. Jagdishan sir has in-depth and extensive experience in statutory audits, international GAAP audits, reviews of listed and large multinational companies in automotive, industrial market, consumer market, healthcare, IT and ITES sector. He had taken various firm-level technical training sessions on accounting, auditing and corporate laws. He has handled several CP seminars organized by SARC of ICI on Ind AS and accounting standards. With this brief introduction, I would like to introduce Sri SK Jagadishan sir to this seminar. And thank you, sir. Over to you.
Thank you, sir, for the nice introduction of me. Members, good evening. And so we have a plan to discuss 3 auditing standards today, and those are SA 250, which is laws and regulations, SA 260, which is about how to communicate to a board or who's governing the board. Okay, and then we'll also see how to communicate deficiencies of internal control. Yeah. So now I am sharing the presentation. Fine. So before we move on to the presentation, so I have 1 or 2 suggestions to all of you. Kindly make a note of whatever queries you have, or please share them in the questions box available in your screen, so that those will be summarized, and later on we will take it up separately. So I'll try to answer each one of those. Any questions are most welcome, which will definitely clarify for a larger population. So don't worry about the quality of the questions which you are intending to ask. Okay. Now let us move on to the presentation. So generally, in general, okay. So nowadays audit as a profession has undergone a lot of criticisms, and then there are many comments being passed on by public authorities. Now so these are some of the standards which requires us to communicate, okay, which requires us to do set of procedures, and then discuss with management, seek external advice or legal opinion. So these are some of the guidances which are clearly or beautifully summarized in the form of standards on auditing. Okay, so these provides large guidance. Okay, so the moment we sincerely follow each one of these points written in the standard, it is easy for us to defend ourselves in terms of how we arrived at the conclusion or anything for that matter. Okay, so now let us move on to the standard. Okay, so this is about consideration of laws and regulations, and so the topic itself specifies that laws and regulations in relation to an audit of financial statements. Okay, so we'll have to take I also want to give an explanation that there is a difference between laws and regulations and litigations and claims. Okay, so laws and regulations is generally whether the company or an entity. Okay, so predominantly what is happening is we call company, and it may also be applicable in case of a partnership firm, and there are many such entities, say a trust. Okay, so standard is written keeping in view all the structures as a whole, but generally, such audit committees, all of those, whatever we are discussing, are formed in a company because those are mandated by SEBI and Companies Act and things like that. Okay. So so when litigation is something arises only when there is a notice or a show cause notice, to simply start with, or an inquiry. That is after a communication is received by the company from a government authority. Okay, so those are called as litigations. And before that, there may be something. There are a lot of things. There are so many laws in India, or so many laws are in countries, foreign countries, wherever the companies incorporated in India have subsidiaries operate. So those are some of the critical things which the auditor is mandated to follow. Okay, not follow. Company is required to follow. Auditors is required to ensure two things. One, whether there is any misstatement, and to prevent those misstatements, he should do some work. And in case of insignificant laws and regulations, he should see what are the potential fines or penalties which may arise. These are the sets of things which the standard requires us to do. Okay. Now let us move on to the content. So what are we going to discuss in the standard? So we are going to discuss in 3-4 summarized form. So how the standard is applicable, which is, see, I'll tell you how the auditing standard is structured. Auditing standard is structured in a way that what is required by the auditor to do. For example, I'll tell here that the third table is very important. Third agenda is very important. And the fourth agenda is also important. 1 and 2 generally tells what we already understand. Okay. 3 tells what are we supposed to do. Invariably and mandatorily we are supposed to do with those requirements. And these procedures also are suggestive procedures. We are supposed to follow all these procedures. Okay. I'm sorry. Okay. So the standard is applicable. Okay, standard is generally applicable in case of audit of finance. It is very clearly written. So it is not applicable in case of other assurance engagements. Okay. So it is not applicable. So as the standard is written, the name of the standard actually says laws and regulations in an audit of financial statement. That's all. Okay. So which means that when you do an audit, there are some set of laws and regulations. Only you are confined to do this set of procedures in an audit of financial statements. That's all. It is not applicable in any other assurance engagement, certification engagements, nothing. Okay. So the standard is applicable way back in 2009, but it is very, very important. The standard is absolutely important. And what the standard is required us to do, the objective of the standard is, there are 3. 1, there are standards which are directly affecting the financial statements. Okay, when I mean affecting, those the determination of the material amounts are directly in relation to those. Now, what the auditor should do, he should get sufficient appropriate audit evidence that they are not materially misstated. Number 1. Number 2, there are set of audits or there are set of laws and regulations which are not applicable or which will impact the financial statement directly. So what are we supposed to do? We are supposed to follow set of procedures to ensure that those auditing procedures will not reveal any specific non-compliance. Number 2. Number 3. So what happens when there is a non-compliance? Okay. So how to respond to those non-compliance? How to communicate to the management or those charged with governance or with any third party? Can we communicate to third party? These are the guidances which is available, or the objectives of auditor that the standard is saying. So that SA2 should be followed. Okay. So now, so before we say, so laws and regulations, now what is this? The standard says what is a non-compliance. A non-compliance is nothing but an act of omission or commission by the entity, even if it is intentional or unintentional. Okay, which is generally contrary to the prevailing laws and regulations of the particular country. Okay, so who will undertake those acts? The acts will be undertaken by the entity itself, or there will be an agent. Okay, who will enter into, say there's a power of attorney sometimes given. He will enter into a transaction or anything on behalf of the company, or some transaction will be taken in the name of the company by. There are 3 sets of people. 1 is those charged with governance and the management or employees. These 3 sets of people enter into transactions for the company, in the name of the company, or on behalf of the company. Okay, so if those acts result in a contrary views of contrary compliance to the laws and regulations, then we call that as non-compliance. Okay, specifically there is a specific statement. If there is a personal misconduct by any of those charged with governance or management or employees, that is not considered to be a non-compliance as far as the particular entity is concerned. Okay, so personal misconduct is not a non-compliance. We can have a number of instances. Okay, so those are outside the operations of the entity. That does not have any direct or indirect impact on the operation of the entity. So that is why we are saying it is not significant. Now, so understand this non-compliance very simply. We will move on. See what happens. The standard guides you to identify non-compliance. The standard guides you to say what to do when you see a non-compliance. Then it says how to report those non-compliance. These are the three major things which we'll discuss in next 10 to 12 slides. Okay, now so the standard always, okay, so there is always a discussion between who's responsible, whether the management is responsible or the auditor is responsible. Okay, so now it is very clear, and it has to be very clear to everybody who says what is audit and other things, that management is only responsible for two things. One, whether the operation is in compliance with the laws and regulations, and at the same time the numbers reported, okay, in the financial statements and the disclosures made in the financial statements are also comply with those specific laws and regulations. Simple. So the primary responsibility is always on the management. Okay, so one additional point here I want to make: there is a slight difference between management and the people who are, we call as those charged with governance. It is interchangeably used, but there is a slight difference. We will understand that in the next auditing standard. We may discuss this during the course of this also. Don't worry about it. So as far as now, management or those charged with governance are one and the same. Okay. Suppose there is a board, there is no other audit committee, then board is also called as management as well as those charged with governance. Okay. So now the standard is suggesting a set of illustrative list, okay, as to how the entity can ensure compliance with the laws and regulations. Okay, it says that, okay, management, please make a note or create a legal or compliance framework, okay, and a set of operating procedures to meet these requirements, and then so develop a code of conduct. Okay, so this is very significant. Okay, let me tell you. So there is a code of conduct which is generally circulated amongst a lot of employees. If in case we ever employed in a company, those employees are trained to understand those code of conduct, and then it will be monitored very frequently and regularly. When I mean regularly, so this is a continuous process. Okay, this is a yearly compliance, yearly declarations are obtained from those employees. Okay, and there is and they also may engage specific legal advisors to monitor what is happening in the organization. Okay, so the management is not expected to know all of these. They are taking the help of legal advisors. Okay, so they may also maintain a register. So these all are a set of illustrations, examples given by the standard to the management to implement policies and procedures that will prevent or detect non-compliance with obligations. That's all. Okay. So these are guidances generally. But what happens in a larger entity? So a large entity might be required to have an internal audit function, audit committee, or a separate legal and compliance function, so that they will be responsive to any new amendments, new laws which affect the company's operations, okay, specific disclosure requirements. They will be able to respond to those requirements and tell the management that these are critical for them to comply. Okay, so these all are the things which the management is supposed to do. Okay, now, so that is when, so because this is a primary responsibility, they're supposed to do all these things. Okay, now let's go to the next slide. So the standard classifies laws and regulations into two. So for us to determine what is our responsibility. Okay, now what has happened? There is a set of law which is directly affecting the financial statements, and there are set of laws which are indirectly affecting. Okay, what are those indirectly affecting? Say income tax, GST, excise, PF, labor laws, Companies Act. Those are directly affecting the amounts and disclosures made in the financial statements. Okay, so for example, contingent liability is disclosed based on the litigations arising on account of taxation matters, other labor law matters. Okay, so any change or any compliance which it will have a direct impact on the financial statements, those are called as directly affecting the financial statements. Okay, what is indirectly affecting laws and regulations? These are very simple. Environmental regulations. Okay, so the company has to obtain clearance. Okay, they will obtain clearance in the first year, and then in the second year they'll have to go for renewal. Okay, when the renewal has happened, they have made an application. So those are the simple assessment which the auditor has to make to ensure that there is compliance, but those are not directly affecting the financial. But what will happen if they don't apply for renewal? There may be fines. Okay, those fines, the auditor has to evaluate whether they're for material. If it is material, then you will request the management to have an adjustment entry. Okay, so understand them, what is directly affecting and what is indirectly affecting. Suppose, so we can have a classic example of when there's a change in tax rates, it will directly impact deferred taxes. Okay, so if it happens before the date of balance sheet, okay, when the communication of approval accorded by the president or somebody is before that, then it affects the financial statements on the date of balance sheet. Simple. But these regulations will not have, say, lift renewal license. Okay, environmental factory license. Factory license is necessary for the operation. Okay, company would have made renewal, but due to COVID, if the officer is not available and if there is a delay, then what will happen? The entity can run its operations, but provided there is a satisfactory environment that the company will get the renewals without any issues. That is more important. Okay, so these are, so the bifurcations of what is directly affecting and what is indirectly affecting is very, looks very simple, but sometimes it needs more knowledge also. Okay, for example, so I don't have any examples, but we will keep discussing. For example, if a company is an NBFC, the NBFC RBI regulations, RBI rules are absolutely critical. So in those scenarios, it will come as a directly affecting the laws and regulations. Okay, any change in those NBFC regulations are absolutely necessary for the company to take it, for the company and the auditor to take into consideration very, very seriously. Okay, but for a company which is not into NBFC, those may not have significant impact. Okay, but still they are required to comply with those requirements so that there are no fines or penalties later on. That's all. Okay, now, so what is the auditor objective here? Directly affecting laws and regulations, you should obtain sufficient appropriate audit evidence with respect to compliance. Okay, in terms of other laws and regulations, we have to perform a set of specified audit procedures to see that there are no non-compliance. That's all. Okay, the key point is non-compliance will generally result in fines, and it will also result in litigations. That's all. Okay, now what is the responsibility of the auditor? Auditor is responsible to get a reasonable assurance that the financial statements are free from material misstatements. Very simple. Okay, now what is the auditor's required to see? He is required to see what is the applicable legal and regulatory framework, and he should also consider the inherent limitations of audit. Okay, so when we say what is applicable legal framework, so this is obtained with the help of past experience. Okay, so we'll get into those things, but we will also discuss inherent limitations in detail. So what are inherent limitations? Inherent limitations of an audit is that the auditor may not be able to identify all the defects in an audit. This is mainly on account of many issues that the management may not communicate to us. Okay, we may not be aware of a set of business which they are doing. Okay, so I'm not saying so all the business. So for example, a company like Paytm, so they make a lot of business and suddenly they get into some business. Okay, it is not expected by the auditor to have the full knowledge of everything at the same time. Okay, the company is supposed to know, but what happens? There will be some immaterial laws and regulations, so we may not be aware of. Okay, so those are inherent limitations. Okay, now the second point, there is a management fraud. The management fraud is such a way that there is collusion, forgery by management, and they have made intentional misrepresentations. So these will protect the auditor from having. So to say simply, these are naturally inherently limited on the knowledge of the auditor to have a free frame. Okay, so what the auditor is supposed to know, so he will know what is directly applicable generally. Okay, he will come to know other laws and regulations only by way of discussions with the management. Okay, so whenever the auditor is planning for an audit, okay, the designing an audit procedure, he is supposed to see what is the legal regulatory framework generally the company operates and other applicable laws. Okay, there may be law. See, every day there are so many requirements and circulars, notices are being issued. Okay, if it is not directly applicable, the management is only responsible for complying with those things. Okay, so we are inherently have there are inherent limitations on audit. Okay, we should also take into considerations, but that does not mean that we will not. So we will hide the entire thing in those inherent limitations, but we will do set of procedures and prepare documentations towards those. Okay, now fine. So how will the auditor get an understanding of laws and regulations? Okay, so he will get an understanding by past experience, that is existing understanding of the entity industry. Now he will discuss with the management to understand whether there are any change in those laws and regulations. Okay, and then so if there is litigations, fresh litigation which has arisen, which has been issued in the current financial year. Okay, so these things happen over a period of audit, number one, and at the beginning of the period, the auditor may hold a meeting with the management to understand the applicable laws and what are the policies which the companies have framed and how they are identifying and evaluating for litigations and claims. Okay, so these matters will. So there are many other procedures we will discuss. So this is a set of initial stage at which the auditor will get an understanding of the legal and regulatory framework. Okay, two things: what are the legal and regulatory framework and how the entity is complying with those things. That's all. Okay, now the next thing, laws and regulations generally recognized to have a directly. So this is nothing but laws and regulations which have direct effect on the material amounts and disclosure in the financial statements. Now what the auditor is supposed to do as per the objective paragraph, he is supposed to obtain sufficient appropriate audit evidence. That's all, number one. So what are we supposed to consider here? There are many laws and regulations, okay, which are relevant to the entity financials. How to get an understanding of those things? We have to get an understanding of those things by seeing the form and content of the financial statements, and then industry specific financial reporting issues, which may be say an RBI regulation, an insurance company, an electricity company, for which they are required to make specific disclosures. Okay, so if there are contracts with governments, they might ask you to disclose something in a separate format. So are they required to do? And then what are the accrual or recognition principles for income tax and retirement benefits? So these are some of the things which might drive to understand the direct effect laws and regulations. Okay, so some of these matters may also require specific assessments. For example, completeness of income tax is something which is invariably has to comply in a financial statement. Okay, we cannot say we have provided only 50% of income tax. So those things are not acceptable to government authorities or to any user of the financial statements. Okay, completeness has to be ensured for taxation matters, right? Non-compliance, as I already explained, what will happen if there is a non-compliance? Non-compliance will result in fines, litigations, and other consequences, other costs, which may have to be paid. Okay. Now, so what are the procedures? What are the procedures to identify non-compliance? Okay, so non-compliance. So first, as a first step, what the auditor can do is he should inquire with the management or with those charged with governance to see or to understand whether the entity is in full compliance with laws and regulations. Okay, this is the first step. Next, second step. So the paragraph in blue is the standard, and the below table is nothing but the guidance given in the standard. Okay, so first step is inquiry with the management. Second step is inspecting correspondence. So for example, during the period, if there is any so-cause notice, okay, so what are the so-cause notices issued in the specific period? So the auditor is supposed to inspect or get an understanding of all the, so get a copy of all the correspondences from the government authorities, say GST notices, income tax notices, okay, orders given during the period, and how the management has responded. So these inspection will also help the management to see if there are any potential non-compliance, right? Okay, fine. So we'll move on. Okay, now non-compliance brought to the auditor's attention by other audit procedures. What happens? So there are many audit procedures which we carry out. Okay, if there may be a set of audit procedures which will give non-compliance, so the standard requires us to remain alert. Okay, remain the auditor alert at all points in time to understand that there is always a possibility of non-compliance with laws and regulations. Okay, such what are the other audit procedures you can still do? So as I told you, there are audit procedures 1, 2. So inquiry with the management, inspection of correspondence. Now you can also read the minutes, okay, and inquire with the company's legal counsel or external legal counsel. So there are cases where when there is a non-compliance, now it's a general matter that we will get a legal opinion from the lawyers, from the advocates, okay, stating that the company will have a good chance to defend their argument or something like that. Okay, so and then we will also generally perform a substantive test, which is nothing but a vouching part, okay, to see the class of transactions and account balances or the disclosures are accurate. Okay, now, so these are set of standard procedures. Now what happens? Return representations. So the auditor may ask the management or those charged with governance to provide. Okay, see, generally the standard requires shall request, which means it is a must that you get a management representation that all the laws and regulations are complied with. Okay, in the absence of suspected, if the auditor believes that there is no identified or suspected non-compliances, okay, the auditor is not required to perform the set of procedures which is specified above. Okay, it means that inquiry with the management and all is not required to be done. But okay, so now, okay, here the significant point is return representation is not the only audit evidence. Okay, so that is what, if you see the key consideration in the bullet number 2, return representation is mandatory to say that the management has complied with them and they are confirming that to us, number 1. Number 2, and the auditor generally, okay, cannot rely only on representation. He is supposed to do procedures. Okay, every day, whenever there is an audit, they should generally hold a meeting with the management, the finance team, to understand how they are complying with. Okay, the meeting with legal team will tell us what are the extra things they are doing. Okay, what are the extra notices which they are acting on. So those are very, very important. Okay, so return representation is a proof that they are complying, and it is not a sufficient appropriate audit evidence to us. Okay, we'll move on to the next step. So these all are requirements what the auditor should do at the time of considering laws and regulations. Okay, now the audit procedure, if there is a indications. Okay, so now how to identify non-compliance. So how to identify non-compliance? There are set of, these are indications. And what are those indications? Suppose government has ordered an investigation in the operation of the company. Okay, so what will happen? So there might be an investigation. It might go on for a week or 10 days or something. Okay, so they have those things. The company makes a lot of payments towards unspecified services. They make a lot of loans to consultants. So these are very, very indicative that the company is doing something. Okay, they're compliant, non-compliant, or they're doing something which is not in accordance with law. Okay, these are those illustrations. Unusual payments in cash. Now you cannot make payment in cash. You are making a lot of legal and retainership fees, and then unusual transactions. Company registered in tax havens. There is an adverse media comment. Unauthorized transaction, improperly recorded. See, these are indications that non-compliance might be present in the company. Okay, this is an illustrative list, and the above is the auditor should get an understanding of what is happening inside the company and how to get a possible effect of those on the financial statement. These are the two things which has to happen. Okay, the indicators are here. The indicators will provide only guidance. Okay, these are only an illustrative list always. There are more other illustrative which might come into play. Okay. Next, indications of non-compliance. See what will happen if the auditor becomes aware of an instance. Okay, the auditor should obtain. Understood? Now, what will happen? He should evaluate what is the potential financial consequences of non-compliance. Okay, whether such financial consequences require any additional disclosure in the financial statements, and he should also evaluate whether such non-compliance or potential financial consequence arising in account of non-compliance is so serious to question the fair presentation of the financial statements itself. Okay, so this is very significant, right? So matters relevant. So non-compliance will result in financial consequence, which we already discussed, that it will result in fines or penalties. That is nothing but the financial consequence. Financial consequence will result in two things: one, whether it requires disclosure; two, whether when there is a question on fair presentation, it is materially misstated. That's all. Okay. Number one. This is where we should get to. When there is non-compliance, we'll see what is the financial consequence, and financial consequence will lead to disclosure or adjustment. If there is disclosure, it is okay. If it is minimal, it is okay. Disclosure is fine. If it is significant and material to the financial statement, the adjustment has to be made in the financial statement. If adjustment is not made, there is a question on the fair percentage of the financial statements. Okay, and the financial statements are misleading. Simple. Okay. Yeah. Now. Okay. Fine. So what will happen when there is a financial consequence, when there is a non-compliance? What the auditor is supposed expected to do? He will discuss with the management. Okay. So what now the key question is, who's identifying this non-compliance first? If the management or those charged with governance identify this non-compliance first, they have an obligation to tell the auditor. Number one. If they don't tell, then what will happen? If the auditor identifies, then auditor should discuss the matter. The moment audit discusses the matter with the management will try to do two things. One, defend itself that it is in compliance. Number two, if they say that okay, they have discussed with some legal counsel, they get a legal opinion. So which means that management will try to explain as to how they are compliant with the laws and regulations. Fine. This is what this particular slide is trying to communicate. When there is non-compliance, auditor will discuss. Okay, auditor will discuss. Management will give some explanations. If the auditor is satisfied with those explanations, it is okay. If he requires some more additional evidence, he will discuss with the in-house legal counsel or the external counsel about the application. Okay, what are the possible effects on the financial statements? If he considers that the entity's legal counsel are not giving correct picture, then what will happen? The auditor may employ his own legal. He will get a legal opinion on his own to see that there are no potential non-compliances. Okay, so this is what. So the steps are this: when you identify non-compliance, discuss with the management. Management is expected to provide how they are complying with laws and regulations. Number one. Then they will say, okay, we have a legal opinion or we have a legal expert. You may discuss with them, or he will be in a position to give you a write-up or something as to how this transaction or something is compliant. Number one, if the auditor is satisfied, he's okay. If he is not satisfied, then what will happen? Then he will try to evaluate if he can get some legal advice on his own. Clear? Okay. Now, if the auditor is believing that, it is very important. If the auditor is believing that he does not get sufficient information, okay, about suspected non-compliance, what will happen? Auditors should clearly evaluate there is a lack of sufficient appropriate audit evidence on the auditor's opinion, okay, which will lead to qualified opinion or whatever. The results are there, okay, in the standard itself. What you will do when there is no evidence, right? Okay, if there is no sufficient information, it means that you are not obtaining sufficient appropriate audit evidence. That's all. Okay. Now, evaluating the implications of non-compliance. So, what is the auditor expected to do? Auditor should evaluate the implications in relation to other aspects of the audit. Okay, why? So, some of the non-compliance might have pervasive impact, right? So, whether the auditor risk assessment is correct, okay, whether the auditor can rely on the return representations obtained. Okay, these are the basic questions which might arise the moment there is a non-compliance, right? Okay, so now how implications. The implication is very important. How the implications, depth of the implication is very important. Depth of the implication depend on two things. One, the relationship of the perpetration and the concealment of the specific activity, and the level of management or employees involved in such non-compliance. Okay, if the non-compliance is, say for example, there is a delay in filing of GST returns. Okay, those are very small. Okay, it will not be done by say at the level of board of directors. So it will be done. There may be some oversight. They would not have filed. But if there is, so if the management itself argues that they are not supposed to pay tax, okay, some taxable service is not taxable as far as their view is concerned. So those kind of non-compliance are very, very significant if the at the management level, okay, at a higher level, and it will become a very small thing. So the implication and then the addressing of those issues, if it is at a lower level of management, will become easier, and if it is at a higher level authority, and it becomes very, very pervasive in nature. Okay. So what will happen to the auditor? So sometimes, okay, the standard says it is very interesting, but standard says if it does not, the implications are very significant. The auditor might also consider to withdraw from the engagement. Okay, and withdraw from the engagement. Okay, he may also seek a legal advice and do so. Right? If he is not supposed to withdraw, okay, if the company says you cannot withdraw, now what will happen? The auditor will consider alternative actions where the audit report, where he will specifically mention those things in the audit report. Yeah. Okay. So what will happen? So now there is a suspected non-compliance. The auditor shall communicate those to board or those charged with governance. Now, see, as I told you earlier, when the management and those charged with governance, they are different. They are also different, and they are same in many companies. They are different, and not all of those are involved in the business activities. Then the auditor is supposed to communicate those non-compliance to the management as well as those charged with governance. Number two, if the matters which are non-compliance matters are inconsequential to the financial statements, then they may not require, so they are not required to report to those charged with governance. Now, if if the non-compliance is believed to be intentional and material, the auditor should ensure that he will communicate these matters to those charged with governance ASAP. There's no delay. Okay, if there is a delay, then what will happen? So the set of procedures might get delayed, so that you will not be able to meet deadlines, because there are timelines to report to SEBI and all those things. Okay, when if there is no, so if there are no those charged with governance, the auditor should try to explain the matter to the higher level of authority of the entity. Okay, so if you are an auditor of a subsidiary company, and subsidiary company, there is no difference between management and those charged with governance generally, and then the auditor is expected to communicate to the management of the holding company. Okay, that is the best way to protect yourself, that they should be communicating. So you cannot say that no, you have informed, the auditor has informed to the GM finance of subsidiary company or the board of the subsidiary company. Okay, so this is not correct. They may also evaluate who's the next level of authority. Okay, so in this case, the holding company's management will become the next level of authority. If you are sure that there is a next level authority, there should be communication to them. If the auditor believes that the communication may not be acted upon, okay, so you are trying to implement, so you are communicating to the board of the holding. If they don't respond, then you would say, you will get a legal advice and see how you will report those matters in the audit report. That's all. Okay. Now, this is the final stage. So what will happen if there is a non-compliance? Okay, and the non-compliance is having a material effect, and they are not adequately reflected in the financial statements, which means there is a non-compliance, there is a financial consequence, and the financial consequence is material to the financial statement. Now, what is material? Then it has to be adjusted. The numbers has to be adjusted in the financial statement. Numbers are not adjusted. Then what will happen? This will result in an inadequate reflection in the financial statement. Now, what will happen? The auditor is supposed to express a qualified or adverse opinion in the financial statement. Okay. Now, this is the first step. Here, there is no limitation on the part of the auditor. When I mean limitation, the company is not protecting the auditor from getting an audit evidence. Second point is interesting. The auditor is precluded by the management from obtaining sufficient appropriate audit evidence. Then what will happen? You are not having any number, okay, but you believe that it is very significant. Then what will happen? You will disclaim the opinion or a qualified opinion. So yeah, so this amounts to a limitation of scope on the limitation of scope of the audit, right? So it amounts to disclaimer of opinion. Now, if the auditor is unable to determine whether the non-compliance has occurred, okay, because of the limitation imposed by the circumstances, now what will happen? Same, more or less disclaimer or adverse opinion will come into play in this scenario. Very, very clear. Okay, so the first point is the auditor is able to perform set of procedures, and he is able to identify a number which is financial consequence arising out of those non-compliance, and the adjustment is not made. Then you will only qualify or express an advice. If this very matter is very significant, then you will go for adverse opinion. Okay, a positive or negative scenario, something like that. Okay, now if the auditor is protected, okay, precluded by the management from obtaining audit evidence, then that's all it will go for. It is a limitation to scope of audit. Then we will explain a disclaimer of opinion. Now, so these are the matters. So what the auditor is supposed to do when there is a non-compliance, right? Okay. So whether there is any requirement, so the standard says, so you have identified non-compliance, can you go on your own to tell, say, income tax department that the company is not paying tax, which is not allowed. Okay, so the first professional duty or the main professional duty for an auditor is to maintain confidentiality, which is not allowed. Now, number two, so there are a set of framework which allows, for example, fraud reporting under Companies Act, under section 143 subsection 12. What you are supposed to report fraud committed by the management or on or by the company, you are supposed to report. So reporting You should share the report, discuss with the management, and then those reports will be shared to the central government, right? So only if there is a law that you are supposed to do some set of reporting, then you will do. Otherwise, you will not do anything. Okay, there are set of matters which RBI requests the auditor of an NBFC to report. You will report. Okay, but it is not that you will report without communicating that to the management. We have to discuss and communicate with the management, and then we will have to report. If there is nothing, you cannot report to third parties. Okay. Now, so what the standard is required? The standard is requires the auditor to document all of these things. When I mean all of these things, that they should maintain the records. Okay, what are those records? The audit documentation should include minutes of meetings held with management. Okay, they should have copies of all the, say for example, so we have seen 2-3 set of things. Copies of minutes should be obtained, discussions with the management, inspection of correspondences. You should maintain then circulation of legal opinions, copy of legal opinions obtained by the management. Okay, those are minutes. These are the things the auditor has to build to ensure to demonstrate the authorities and when there is a peer review, the auditor has to demonstrate to ICA that they have performed a set of procedure to obtain sufficient appropriate audit evidence in respect of laws and regulations. Okay, so this is very important. And then so without documentation, you cannot say that the auditor will not be in a position to prove that he has performed a set of procedures, and then it amounts to non-performance of those audit procedures, and you are not in compliance with section SA 250. Clear? Okay, so this is what, okay, there are lots of examples which I could think of laws and regulations, and how to react those laws and regulations are very simple. Okay, I would like to discuss later. Okay, what is the impact on those laws and regulations? You cannot say. So suddenly, so COVID is a matter. Okay, so what happened in the last year? There was a sudden lockdown. So how the management was ready in the first lockdown and second lockdown is totally different. Fine. So what will happen? How that will affect the operations of the organization? So whether those are directly affecting financial statements or indirectly affecting financial statements. So these are the matters, and there are many other examples which we can think of in terms of non-compliance. Suppose there is a hospital, for example. I remember in the past, in one of the major cities, there was a fire, and then the hospital has been constructed in non-compliance to the fire regulation for the particular state. It resulted in few casualties, but what will happen? So they are not compliant with the laws and regulations, but those are other laws and regulations. Okay, so but the management is expected to comply with those things, but what will happen? Okay, so that is why I'm saying, so we have to clearly have our documentation in terms of what are specific and directly affecting laws and regulations, and every year the management should, or the auditor should meet the management or those charged with governance to understand how these are being complied with. Okay, and see what are the other laws and regulations which generally the company complying with arising on account of other transactions. Okay, so please park your questions. We will discuss that at the end of this session. Okay, now we'll move on to the next standard. 1 minute. Fine. See, so far we said non-compliance. So for example, this standard dealt with laws and regulations. For laws and regulations, the auditor might identify a non-compliance. They have to discuss with the management. How will they discuss? Okay, so it is not that, okay, suddenly in a large organization you will discuss directly with the director, managing director, CEO. That's not the case. Okay, so this standard which is on the screen, so this standard say 260 which is communication with those charged with governance, will give guidance as to what the auditor will do when they identify. So what are they supposed to communicate? Okay, what is expected out of the auditor? There are many things. Will be each and every standard will say what are you supposed to do. Okay, this standard is nothing but a summary of those standards, and in addition to how to make a communication to those parties. Okay, this is very critical now, but this is very procedural in nature. Okay, and at the same time, it is not so it has given a lot of illustrations, and there may be timings. Okay, form of communication, there is no format which is specified or nothing. Okay, it's all purely judgment basis, but at the same time, this gives a fair amount of explanation as to how a communication between the management and auditors should be effective, and it talks about two-way communication. They should tell what they have observed, and we should discuss all the things which have gone right, wrong in performing an audit, on all those things. Okay, so this is a larger standard. Say 265 will be fairly simple. Okay, that is relating to internal control, and then internal control has significant deficiencies and all those things. This is a general matter. Okay, general matter and significant matters. Okay, now same more or less all the standards say what is the management responsibilities, that requirement, what are the audit procedures should perform. Okay, now we will discuss these things. Now, what the standard deals with audit responsibility to communicate those with charge of governance in an audit of financial statements. Okay, so this is applicable from 2017, right? Now, the interesting point is, what are the objectives? The objective is the auditor is expected to communicate clearly with those charged with governance the responsibilities of the auditor. Okay, so responsibilities of the auditor should be clearly communicated. Okay, and then why? So okay, number two, to obtain information that are relevant to the audit from those charged with governance. Number two. Number three, to provide those charged with governance with observations for the time, so significant observations made, so that they will try to evaluate. So what will happen from a financial reporting perspective? Fine. And at the same time, to promote effective two-way communication between the auditor and those charged with governance. Okay. The first point is interesting. So what is your responsibility? Your responsibility as an auditor is to express an opinion, no doubt, right? At the same time, you are expected to be independent. These are the factors. So the standard narrates those things. Okay. So what are those things? So simply we say you are performing an audit only to express an opinion. Now, while performing an opinion, you are expected to be independent, and then at the same time, you are not expected to identify all the errors, okay, or fraud. So those are the set of communication which we'll make. Fine. So there are some procedures, there are some matters which only the management will be able to tell us. So we have to get the information from the management. Fine. So the objectives are very clear, but the standard is very procedural in nature, and very important. Okay, and considering the present scenario, it is very important. Okay, now so let us move on. So now, so as I already told, we will have a definition of those charged with governance, and then management. Okay, who are those people charged with governance? So as I told you, there is a difference between those charged with governance and management. Okay, now we'll understand who are these people. The person or organizations with responsibility of overseeing the strategic direction of the entity and obligations relating to accountability of the entity. Okay, so which means they're mostly the governing council. Okay, the governance. So now let us understand what is a management. Okay, to simply say, management is a set of people who will take the executive responsibility of the conduct of the entity's operation, which means that management is a set of employees, okay, I would say, who see the day-to-day operations of the company or an organization. Okay. Now management is a subset. Those charged with governance is a larger set of people. Okay. For example, if Reliance is a group, the subsidiary company will become management. Okay. Subsidiary Reliance as a holding company will become those charged with governance. Okay. And this is how we have to differentiate between these two people. If the organization is bigger, those charged with governance and the management are totally different generally. Okay, so they'll have only one representative. Okay, they'll have, say, they'll form a majority of the board, and say for example 4 out of 7 will be representing a parent company. Okay, suppose if there is a joint venture, they'll be equally represented. Fine. So this is how we have to ensure. In many cases, those are same also. In case of a small company where we have a small audit which is formed by a owner company, then there is no difference. Okay, the owner and the director and those charged with governance will be same. Okay, so the possible scenarios are those charged with governance and management are totally different in large organizations. Okay, so why this? Okay, suppose this is where we discussed in the laws and regulations. If there is a non-compliance, what is the auditor expected to do? The auditor is expected to communicate the non-compliance to the management. Okay, what the management is expected to do? Management is expected to provide sufficient evidence to the auditor that there is not the case. If there is a non-compliance and it is proven by the auditor that there is a non-compliance, then what the management should do? They should try to provide or make adjustment to finance, which is number one. This is between management and auditor. What the next behind the scenes, the management should in turn discuss that they have not complied with set of standards to those charged with governance. Okay, this portion is very important. Okay, so now there are 3 sets of people. One is auditor, management, those charged with governance. Auditor will generally interact with management, and they won't directly interact with those charged with governance. So there is a gap naturally created between in the audit process between those charged with governance and the management. Now, what is auditor's responsibility? Auditor is clearly responsible as per the standard to communicate to those charged with governance. Okay, so now establishing whether as an auditor we have communicated to management and such management is eligible to be called as those charged with governance. Those are all questions which we have to exercise judgment and ensure that the issue is highlighted to the highest level of authority. Okay, that's a simple term which I can think of and tell you at this point in time. Okay, so you have to ensure that this goes to the highest level. If there is a hidden process, that's all. Okay, and beyond that we cannot do something. So what is the highest level of authority to which we have to communicate is what is absolutely important for us to understand at this point in time. Okay, the standard says the standard provides guidance on how to identify people to whom we should report. Okay, how we should report, whether those are sufficient, how to evaluate those sufficiency, all those things are there in this standard. That's all. Okay, now, so generally those charged with governance and management are different in large organizations. Those charged with governance and management are same in very small organizations. Okay, if the organization is a very decentralized form of organization, it is different. If the organization is centralized and they have one operation, single company operating in Chennai or in Bangalore, and they don't have any branches, no subsidiaries, then it will be same. Okay, those charged with governance and management will be same. Okay, let us move on now. Okay, so this is what we have been discussing. So how the auditor should determine the entity's governance structure. Okay, then he will decide as to whom that he should communicate. Now, okay, so there are examples. Say there may be companies where they have 2 boards. One is supervisory board, the other one is executive board. Those are totally different. Okay, to whom shall you communicate? Okay, now there is only single board. They have both supervisory and executive board. This is called one tier board structure. So to whom shall we report, right? And then there are companies in which members of those charged with governance are also part of, say, board of directors. So can you just say that, okay, so you are there? Okay. In some cases, in some of the boards, government representatives are also be part of. Okay. So can you say what is the governance structure there? Whether you should give the communicate with those authorities or to the government itself or the department itself. Okay. These are some of these things the auditor is required to determine. Okay. As a step one in to comply with these standards. Okay. So the point is, in many entities, governance becomes a collective responsibility of board, supervisory board, and if it is a partnership, it is a partnership. Okay, proprietors, committee, governors, trustees, everything. Okay, it becomes a. So what is the governing body? What is the governing body? Is generally becomes those charged with governance. Okay. In smaller entity, as I already told, the operations are limited to one location, one person. It becomes very simple. Okay, you tell that person, and it is you have communicated to those charged with governance. Very simple. The moment it becomes bigger and bigger and bigger, and in the evaluation or determination becomes absolutely critical. Clear? Okay. Now, no. Okay. So the key consideration is, so this standard will not tell you as to who are those people. It is not possible for the standard to just summarize and say these are the people whom we think is the person that you should communicate. It is not possible because the organizations are so large that standard cannot limit itself to specify those things, list down those things. Okay. And then okay, so why? Okay, the second thing is, whenever there is a engaging party, when there is an audit assignment, somebody will ask you to commence the engagement or do some work. You will enter into so you will naturally give an engagement letter. Okay, that engagement should have that when there is an issue, when there is a non-compliance, or when there is a key matter for discussion, you will say whom do I discuss with. Okay, so generally this formats contain board of directors in India, audit committee, and these are those parties. Okay, so this is something, and the last bullet point is very interesting. If there are a group, okay, so we are taking an example of, say, Reliance or Infosys, and if you are as auditor of a subsidiary company, okay, so what will happen as a component of an auditor of a component, okay, of a component, nothing but subsidiary company, the auditor is expected to submit a set of report to the parent company's auditor, and okay, and to the government, and to the parent company's people. So if you are a subsidiary company auditor, you have to evaluate as to whom you should submit the, or whom you think as a governance structure for this particular entity. Okay, just an evaluation at this point in time as to whom do we report now. Okay, communication with subgroup of those charged with governance. So who is the subgroup? Subgroup is nowadays is quite popular. Audit committee. Audit committee becomes a subgroup. Audit committee is nothing but a committee which oversees the audit and accounting related transaction, financial compliance, which and it's a committee formed by the board of directors, right? The audit committee is authorized to approve the financial statements nowadays. Okay, without approval of audit committee, board will not approve the financial statements. So these are the requirements which has been formed. Now, is it sufficient for the auditor to say that, okay, they have communicated to the audit committee, okay, and then whether it is sufficient for them to communicate just to the audit committee, okay, and then leave with it? That's all. It is not. So the auditor, the answer is no. The auditor should discuss with the audit committee. There is no relaxation in that. Number one. Number two, at the same time, auditor must also evaluate whether these matters has to be discussed with the governing, because they are only a subgroup. Okay, there are people who are governing council, governing body above those audit committee. So what are those matters which determine significance of discussions with the governing body. That depends. Okay, not you may not discuss all those points, but there will be evaluation as to which point will be discussed with the audit committee and which point will be discussed with the governing, right? Okay. So now when you consider communicating with the subgroup, okay, the auditor may consider may evaluate these matters. What are those matters? What is the responsibility of the subgroup and the governing? Okay, nature of matter to be communicated. What are the relevant legal regulatory framework, regulatory requirements? Now, the last point is important. If the subgroup is having an authority to take, okay, required action, right? So if you have communicated some non-compliance where they are able to provide some information, okay, and they need to act upon that. If they are authorized to do that, so it is significant. So that is why. So it is like this. You are reporting to a lower authority. If the lower authority is not empowered to act on some issues, then what will happen? Those things will be non-compliant at the end of the audit period. So that is why this evaluation will help you to communicate to the higher level of authority, right? What is that? Whether this lower authority is authorized, whether this lower authority is capable, whether this lower authority will react. Okay. So these are the points which you will evaluate and then say, okay, if they do positively on all these matters, it is well and good. Otherwise, you will evaluate to report to the higher authority naturally. Okay. So these are very logic driven in my view, but some cases we will believe at the time of performing audit that okay, we have reported to audit committee, which will be sufficient. So just okay, audit is closed, audit documentation is closed. That is where we will do a mistake in the form of not informing those things to higher level of authority, which is to those charged with governance. Okay. Now what is the form? Whether you will submit in a full form or in a summary form is again we have to evaluate, right? So explicit. So this is what the third bullet point says, that if there is a terms of engagement, okay, and if there is no restriction or prohibition by any law or regulation, the auditor shall retain the right to communicate directly with the governing body. So it is not that the auditor should communicate only to the audit committee. They can also tell the board of directors directly when there is a board. Okay. Naturally, at the time of adoption, we can say these are the issues which we have. So not at the time of board we will communicate, because there won't be any time to sufficiently get audit evidence at that point in time. So we have to communicate in advance. Okay. The standard will give guidance on of those things a little later. We will discuss those points. Fine. Okay. Now, so audit committees. Nowadays, audit committee is a fair authority to discuss these issues. So what will happen? So the standard also says the good governance principles that the auditors are generally invited to attend meetings of audit committee. Okay, nowadays it's mandatory for the auditor to make a presentation, communicate whatever we are discussing now. That independence, and then the next set of slides that we will communicate. So discuss with the chairman at a regular period, at regular intervals, and then meet the audit committee without the management at least once. Okay. So these procedures or these good governance principles are quite common in a lot of good listed companies in India also nowadays. Okay. So first point is very simple. Audit committee is mandatory nowadays. Most of the auditors are supposed to attend audit committee. This is mandatory also. Now the second point, meeting the chairman to discuss those issues with or without management. Those are also happening. Okay. So on the audit committee should also discuss, meet the entire management, meet the auditor without the management. Okay, to have a frank communication at least once in a year. Okay. So these are things that will say that there are good governance in a particular organization. Okay. Now, okay, what will happen if those charged with governance are also part of management, right? So this is very simple. In this case, the management and those charged with governance are one and the same. Okay, and there is no separate governance role in this particular case. Okay, in this scenario, if the matters are communicated to the people who are there in the management responsibility role, then it is the matters need not be communicated again with those same set of people. Okay, so the point is this, which was discussed. If the people are same, okay, if they cannot take any name in a public session. So if any person is supposed to be same, if Dhoni is part of a director and Dhoni is same, he is running the organization, he is part of those committee. If you communicate to Dhoni, Dhoni is enough. That's all. Okay, you need not communicate to him as a director and to him as a. You need not duplicate things. That's all. Very simple. Okay. Now, fine. So this is as to how to identify uh, who's the governing body and what is a subgroup and how to communicate, if they are same, how to communicate and all those things. Now next we are proceeding to what are we supposed to communicate. We are supposed to communicate 4 things. One, what is auditor's responsibility in relation to audit, financial statements audit. Okay, what is our planned scope and timing of the audit. 3, what are the significant findings in audit, and 4th is independence. Okay, we'll discuss each of these things elaborately in the coming slides. So why this has to be disclosed? Okay, there might be a question, and why this has to be disclosed. Okay, this is anyway we are following as per ICI. As per ICI, why we have to follow? Why we have to tell that? Yes. Okay. Fine. So you have to discuss, no? So all these things has to be communicated. Otherwise, there will be clear. What I can say? The standard requires us, as we have seen, there is no two-way communication if you don't tell all these things. Okay, that's all. We'll see as to why that will be proven in next 2 to 3 slides. So, what is the auditor expected to do? So, auditor is expected to communicate, okay, the governing body, which is those charged with governance, of his responsibility. As I told you earlier, what is the responsibility of auditor? Auditor responsibility is to just form and express an opinion on what? On the financial statements that have been prepared by the management. So which means the management is preparing the financial statements, management is being overseen by those charged with the governance. Okay, and we are reporting, or we are forming an opinion and expressing an opinion on those financial statements. Okay, number 1. Number 2, auditor does not relieve the management from their responsibilities, which we have to communicate. So it is very simple. When you take an audit report, what is there? There are 2 things which is invariably available other than opinion. What is there? What are those things? One is first thing is opinion nowadays, and second thing is management responsibility. Third thing is auditor responsibility. Okay, very interesting, right? So we are only responsible to express an opinion, and they are responsible for everything, even though we have performed an audit. This we have to tell them. Now, second thing, auditor should also communicate planned scope and timing of the audit. So what are they say? So what is this? See, meaning it is not, we know what is audit. Audit is the scope. Okay, within that, what are we expected to do? Okay, say for example, we should tell in advance that if there is a non-compliance earlier, that there is a major suit against a litigation against a company, and then we should tell in advance that we need a legal opinion. Okay, so these are the sum of set of timing, and when are we expecting those legal opinions and discussions? What are the significant risks, and what are those audit procedures to be performed to address those significant risks? These are the points which has to be communicated to the governing body, which is those charged with governance. Okay, it is not, so it need not be elaborately communicated, but overall we should communicate all the significant matters. We should communicate. Okay, and then the third part. So the timing of each of this communication will be totally different. Okay, timing of the so not at a single time you will discuss and then forget about other things. It is not that way. Okay. Now significant findings. So these are the significant findings which is provided in paragraph number 16 of the standard. The first is what are the qualitative aspects of accounting practices? Good, bad, aggressive, regressive, all that things. Okay, we may discuss. Okay. And then what are the significant difficulties encountered during the audit? Suppose the samples provided by the management has taken a lot of time than expected, right? And then there are many other things which we will find difficult at the time of an audit. And then what are the significant matters discussed with the management? Written representations, okay, the points written over there. And then content of audit report. Why content of audit report is required? Suppose if there is a qualification, okay, the wordings of those things may be discussed or has to be disclosed to the management. Okay, if there are any other significant matters, those are also to be discussed. Okay, this should be communicated in advance. Now, independence. In case of listed company, the engagement team and others, okay, of the firm, and if there is a network of firms, okay, those network of firms should comply with ethical requirements regarding independence, which means that, okay, so as you all know, there cannot be any share owned by reporting engagement team and other things. Okay, the firm is supposed to ensure that its team, the firm, and the network does not have any independent issues. Okay, and then the second point is all relationships. For example, there may be scenarios where the auditor might also provide taxation services, okay, return filing services, other certification work might have been undertaken by the statutory auditor to its own parent company, subsidiary company, and all those things. Now, the auditor is supposed to report to the board on the fees charged for each of those assignments and how much they have charged and what are the assignments which is undertaken. So this will enable the management to assess whether they are clearly independent from the auditor. Now, the related safeguards. So the auditor is also expected to disclose or communicate what are the safeguards which they have undertaken to eliminate the threats to independence and reduce the threats to an acceptable level. Okay, so in a large organization, in a large audit firm, okay, so there are set of policies. Okay, whenever there are a lot of disclosures to be made by the partners, by the engagement team when they invest in stock markets. So these are some of the steps to demonstrate that they are taking steps, they are taking safeguards to mitigate threats against independence. Okay, so this is what. So the 4 things are very slightly important. Only 4 things. Okay, what auditor responsibility. So what is that that we are going to do, and when are we completing the audit, and then significant audit findings, independence. Okay, so now we'll discuss these things in detail. So auditor responsibility. Auditor responsibility is generally communicated in the engagement letter, right? So the engagement letter will contain point number 2 bullet point. So you can go through also. So it will say towards the audit is directed towards expression of opinion. Okay. Number 2, it need not design procedures to identify supplementary matters to communicate to those charged with governance. Then if standard SA 701 applies, now there is in last 2-3 years there are key audit matters which has to be reported for a set of companies. Now, so what are those? We have to communicate. Sorry. Okay. So these things. Now in the 4th bullet, if there is a laws and regulations, the matters that, for example, there is a peer review. The peer review picks a set of audit. So we are supposed to disclose our work papers to the ICAI. So that matter that we will disclose this work papers or these discussions to ICAI. So these are the matters which should be made available in an engagement letter to clearly communicate with those charged with governance. Okay. Now So this is nothing but an agreement. Okay, if there is a mandate that an auditor is required to submit the report to the third party, there are set of guidance and the standards. So we look at it now. So okay, planned scope and timing of the audit. Now what? See, okay. So why are we supposed to tell what is the planned scope and timing of audit? So this might assist those charged with governance to understand the consequences of the audit better, to discuss the issues of risk and the concept of to discuss the issues of risk and concept of materiality with the auditor, and to identify any areas in which they may require auditor to take action. Okay, why? So those charged with governance will generally understand what the auditor is expected or what auditor will do as part of audit. Okay, number one. Number two, so suppose there are materiality levels, we will communicate. So the management should understand that below the materiality, the auditor is not expected to identify a misstatement. Okay, and then if there is a specific focus area which management thinks that auditor should focus on, they might communicate, they might ask the auditor to perform additional procedure. Okay, sometimes so these are the things. So if you communicate the planned scope, now the management will be better understanding the procedures to be performed, and it will assist the auditor. So first bullet is for those charged with governance to understand the procedures better. Second procedure is to understand this communication will help the auditor to understand its environment and about the entity better. Okay. Now, so significant risk. So significant risk identified by the auditor will help those charged with governance to understand the matters and why special audit consideration is being given by the auditor on that particular significant risk, so that management will be aware of those significant risks later to implement adequate internal controls and reduce the significant risk to an acceptable level. Okay, so it is not that significant risk is something which only the auditor identifies. Okay, it is also understood and being acted upon by those charged with governance or the board or the internal committee, internal control team, internal audit team within the management. Okay, so it will also, so the communication will also assist the governing body to oversee the financial reporting process. Right? Fine. So now, what are the matters to be communicated as part of planned scope and timing of audit? These are illustrative list. Now, how the auditor is planning to address significant risk of ROMM. ROMM is nothing but ROMM, risk of material misstatement, and then how the auditor is planning to address areas of higher risk of material misstatement, and then what is the auditor approach to internal control which is relevant to the audit, and then how the auditor is going to apply materiality in the context of the audit of financial statement, and the nature and extent of skill or knowledge, okay, needed to perform the audit procedure, including auditor expert. For example, in many cases nowadays there is a fair valuation. Okay, so the auditor will communicate those things clearly to the management as to fair valuation. Impairment testing is very common during the COVID circumstances. Okay, and then very popular example of those external expert is actual valuation. Okay, so these are the things. Use of, see here, this speaks about auditor expert, but at the same time there is an external expert. Auditor directly may not employ experts to perform audit procedures. Okay, because there will be an independent issue there. So he may communicate to the management to get a fair valuation from an independent organization, and then perform a set of procedures. Okay, and as we already discussed, if standard 701 applies, the auditor will communicate his preliminary views on the key audit matters. Okay, and then so these are the matters which we will the auditor will communicate to those charged with governance. Okay, which will help as we discussed, will help the auditor to understand the company better, and the governing body to understand the procedures better, to request the auditor to do something additional procedures. That's all. Okay. Fine. So other planned procedures will also include. So these are guidances. Okay. So what are these things? So there is an internal audit function. Okay. How the internal audit and external audit can work together. So these can be discussed with them. So last year we have some significant observations, developments in accounting standards. So these are communicated to the governing body, which is those charged with governance, and they will, in response to, they'll understand. Okay, these things are important. How to address, suggest something extra so that we will comply with. This will happen not only once in the audit, or not at the commencement of this. This has to happen over the period of audit. Okay, whenever there is a board or audit committee, there should be exchange of communication between the board and the auditor, audit team. So this will have a greater impact on the results of the audit. Yeah. Okay, we'll move on now. Fine. So this is about, okay, so we have discussed about planned scope of now. So there are four things which the auditor has to report. The one is audit responsibility, planned scope and timing of audit, and the next one is significant findings of audit. Significant findings. So laws and regulations which we discussed already is only one or an element of a significant finding. There may be many other issues in audit. Say, for example, depreciation is not provided, two-shift depreciation is not provided. This is not laws and regulation non-compliant. Okay, this is an error. Okay, now, so something similar to this, you will have a lot of other issues. Fair valuation, they have taken an aggressive valuation. Projections are wrong. Okay, impairment is not provided. Going concern is not evaluated. COVID impact is not evaluated. These are some of the popular issues in the recent times, in the India scenario or any scenario. Okay, impairment is a popular topic nowadays. Now what will happen? Okay, where are we supposed to communicate these things? So to those charged with governance. So now, so if we inform these things to those charged with governance, governing body will be in a position to provide additional information, further information to the auditor to gain audit evidence. Okay, to complete his audit evidence. Okay, and then so as a result, the example clearly says that the auditor may also confirm with the governing body that their understanding and the management understanding to a specific transaction is same under the same facts and circumstances. Okay, so this can happen only if there is a communication of the significant findings between the management and those charged with governance. Now what are the, so this is the first step, and the second step is qualitative aspects of accounting practices. So what are we supposed to do? Their accounting estimate. Okay, for example, provision of data, something ECL we call expected credit loss model. Last year, so is there any requirement for them to determine how to determine bad or doubtful debts, and how to make provision towards them? Whether there is any need for them to change, whether the accounting policies or estimates are very aggressive, whether those are being consistently applied, complex judgment being taken. So these are the points which will. So this is so what are they communicating? So they are communicating these things will communicate that the issues at all points in time has to be highlighted to them. Okay. So if there is a effective communication between those charged with governance and the auditor, the both of them will have a satisfactory result. That the governing body will think that the procedures are being carried out in a satisfactory manner, and the auditor will get sufficient appropriate audit evidence to form and express an opinion on the financial statements. Okay, very common. Okay, so this here it does not mean that you will suggest an audit procedure, sir. Okay, it does not mean that we will have any comment on those things. Okay, It is not a profit identification model. So it is a feedback on how the accounting estimate, accounting policies adopted by the company will have a result, will have an impact on its own results. Okay, so those qualitative aspects can also be discussed with those charged with governance. Right now, what is on screen is slightly very common thing, which is a significant difficulty. What are significant difficulties which you encountered? Okay, if there is anybody to listen, we know that there are delays by the management. The moment audit commences, they'll go on leave. Okay, management is not willing to provide information. They don't give sufficient time to complete the audit. Unexpected effort being wasted in getting sufficient expected information is not available. Auditor is restricted by the management to get those evidence. Management is not willing to extend its assessment for going concern. These are the examples. Okay, so in many circumstances or in some circumstances, this will result in a scope limitation. Okay, that is why. So these are quite common. All these things are quite common, and we would have experienced in each and every client if you during the auditorship days. Okay, these things are very, very common, right? So the first question the management will ask, why do you need this? Okay, so the answering these things will take 2 days, and then they will take 2 days. By the time the partner or somebody will come and ask you whether you have completed this. Okay, so these significant difficulties, if they communicate over a period of time, the management. So the point is the management should be ready to share the information available with them, and those information should be in a position to provide the auditor with a sufficient amount of audit evidence to form an opinion. That's all. Okay, if it is not the case, then it is poor, and that might go ahead. That might lead to scope limitation for the auditor. Clear? Now, what are significant matters? What are the other significant matters of discussion? So anything. So you can ask, what are significant matters? Significant events that has occurred during the period. Business conditions which have changed. Okay, business model has changed. And then is there any consultations which they have made with accounting and auditing matters? Okay, what are those concerns which the management is expressing or the auditor is expecting? And then application of accounting practices. What are the difficulties? Okay, disagreement, if any, with the management. These are normal matters which arise during the audit, and some of the significant matters. That is why the significant is appearing both in difficulty, significant, qualitative. You will not go and discuss everything with the board or with the governing council. If there is a significant matter, if you discuss, because those are only materially important for us to evaluate, right? Now, so these are the matters. This is a significant audit part. Now, circumstances that affect the form and content. Now, what will happen? So there are scenarios in which the auditor is expecting to qualify, right? So now what will happen? The auditor, okay, may provide the draft of the audit report, okay, modify uncertainty. See, for example, okay, if there are circumstances in which additional information is required, and the auditor is expected to modify the opinion, okay, they shall communicate those matters to those charged with governance, okay, because it will have an impact on their own capabilities of being a good company with a clean report and all, okay. So these matters will help the auditor and those charged with governance to provide additional information as to why they should remove the qualification, or there is any justification to remove the qualification, okay. And it is in no way that the management will definitely ask for removal of qualification. We are here to, okay, only if there is a additional evidence which is provided by the management, then there will be removal of this expected qualifications, okay. No. So what does it change? So suppose there is an unexpected event. For example, COVID was a classic scenario nowadays. So there's an unexpected event that lockdown has been imposed extensively in the last year, partially in the current year. Now, how will those significantly bring modification to the planned audit procedure? For example, audit so far had happened physically, where the audit team will be present in the client's location, or the books are made available physically to the auditors. Now what has happened, and the auditor last year, the entire year, the auditor is expected, or they have been provided with the soft copies, PDF versions, and then we have learned to perform procedures over the computer. Okay. Now these are the planned procedures which will change, and how the audit strategy will change, and then what are the timing, and how do we expect to complete the audit. So these are the matters which will help the auditor and to communicate to those charged with governance about the change in planned audit procedures. Okay. No, the last point is slightly maybe I'm not sure if many of you will be aware. In large accounting firms, what will happen? There will be an EQCR, there will be an engagement team, and engagement partner will be there. Okay. The moment they are finalized, the financial statements will be shared, and whatever matters which we have discussed so far will also be discussed with the EQCR. EQCR will review independently those financial statements, and he'll be an expert in a particular field. For example, if the company is in an automotive sector, an automotive sector expert will review the financial statements, and they will give their own comments. All right. So these comments, okay, if they're significant and provide some value or criticism which the management should look into, they may also be communicated to those charged with governance. Okay. Yeah. So EQCR is somebody who's within the firm, and then they will ensure quality in terms of reporting, entity, firm level initiations towards ensuring quality. Fine. Now, so again, so what are the matters? The relationship, if there is a change in relationship towards independence, okay, if there is a problem, then those things has to be communicated. And if there is a restriction imposed by ICAI suddenly on some topic, then those things should also be communicated to those charged with governance. Okay, so these matters will definitely help those charged with governance to respond, not only to respond, but to understand how audit is being carried out, and whether they are in a position to answer, respond to the queries or significant findings made by the auditor. Okay. Okay, fine. So how to communicate? So far we have discussed what are the matters to be communicated. Matters to be communicated are simple. One is auditor responsibility, planned scope and timing, and then significant findings during the audit, and then independence. Okay. So this all will be under significant findings during the audit. Okay. Now, so how to communicate? How to communicate is how to establish communication process, and what are the forms of communication? Timing of communication. Timing of communication is absolutely simple. ASAP, as soon as possible, as soon as practicable. Okay. Adequacy of the communication process. That's all. Okay. We will see this in detail. Now what will happen? How to clearly communicate? Clear communication of audit responsibilities there in engagement data. Now, two-way communication. The purpose of communication. So this all is relating to communication. Okay. So why? It will bring the improvisation. It will bring two-way communication. It will have a good, effective communication. That's okay. Okay. In terms of in a large organization, the communication will be very, very formal, and in terms of a small organization, communication will be in a less structured manner. Okay. So it may be in a form of email or return communication. A simple engagement letter should also be sufficient. Okay. Fine. So this is how you will establish the communication. Okay. What is communication with the management? The management. So many matters are generally discussed in an audit process, and including, we will also discuss the matters which are supposed to be discussed with those charged with governance, right? So before So before any matters are being, so because as I told you, management is a lower level of authority, so which will have a day-to-day operation, which will have a review, so which will be on the functioning or the executive role of the organization. And then, so before you discuss anything with those governing body, the auditor will discuss with management. Okay, will discuss with management. If it is considered it is not inappropriate. Okay, inappropriate meaning, so you will not say that. Okay, so the example, so I have written the example given in the standard because it's very straightforward. Now what will happen, you will not see, you will see these issues, you will discuss only with the governing body, not with the management. Okay, you cannot question the management competence with management, so you may skip to discuss with management and then tell those charged with governance, right? Something. So what is communication with third parties? Third party, for example, ICAI, bank, RBI, government, MCA, central government. Central government is MCA. Okay, so are you required to communicate something to the third party? If you are so whenever there is a report being shared to third parties, okay, and the return represent and the return communication is prepared for those charged with governance, the return communication to those third parties, okay, should carry these bullet points. Okay, what are those bullet points? The communication is prepared for the sole use of those charged with governance, and where applicable, the group management and the group auditor should not be relied on by the third parties. Okay, that no responsibility is assumed by the auditor to the third parties, and any restriction on those on disclosure or distribution to third parties. Okay, so if you had prepared any certifications and the guidance on certifications, clearly carry these points. Okay, because the intention of the certificates are generally given to the third parties. Okay, now what will happen if there is a requirement, and if there is a requirement as per laws and regulations, and then only the auditor is supposed to disclose. Okay, otherwise he will not disclose. Okay, done. Fine. So this is something effective communication. So effective communication is two-way communication. So what is effective mean? What structured presentations, return reports, issues, closure of issues. So these are some of the things which we generally do in large organization. So presentations is a popular mode of communication to them. Okay, how do we communicate? Okay, what is the form of communication? Whether discussion matter will be included, that will be said. Whether the matter is satisfactorily resolved. Okay, whether the matter has been previously communicated matter, and what is the result. Okay, how the management has tried to address if you had communicated previously, and then what are the legal requirements. So what the auditor is expecting from those charged with governance. So these are the things in respect of, these are the things which are clearly communicated to the governing body, right? Fine. When a significant matter is discussed with an individual member of those charged with governance, okay, the auditor, it is appropriate, it may be appropriate for the auditor to summarize the matter in later communication so that all the PCW have balanced and full information. Okay, now the critical point here is, okay, so there is a chance that the auditor is able to meet only one person. Okay, and he has gained some knowledge, and the knowledge is made applicable or made available. No, it is not, sorry, it is not made available, and the knowledge is used to collate additional information, and based on that we have concluded an audit evidence. Okay, now this point, this fact has to be explained to the other members of those charged with governance, other members of the governing body. Okay, so that there is a general awareness of the information being provided to the auditor, and because of the information there is a result. Okay, this is how the auditor is able to conclude, get a conclusive evidence. Okay, so how that has happened, right? This will come up. So it is nothing but the auditor should ensure that whatever he is communicating with a member of governing body to all other members, that he has discussed with this person, and this is what these are the results of those discussions, right? Fine. Now, timing of communication. So this we have discussed. Okay, though it look elaborate, this is nothing but whenever there are issues, and if that is very significant in nature, and it should be communicated to them immediately. Okay, as soon as practicable. So it may be appropriate. Sorry, right? So, for example, so it says the communication of planning matters should be discussed upfront at the time of commencement of audit. Okay, and then if the significant difficulty is encountered, then the auditor is expected to communicate as soon as practicable, so that those charged with governance will be able to assist the auditor to overcome the difficulty. Okay, uh, if such a significant difficulty leads likely to lead a modified opinion, okay, the auditor should tell as soon as practicable, right? Now, so whenever there is a 701 applies, the preliminary views about key audit matters should be communicated by the auditor to the those charged with governance. Okay, independence matters, findings, and then auditors' views about qualitative aspects. Okay, when in case of general purpose or special purpose financial statements, they may have to coordinate with the timings of communications. Okay, when we have to discuss, say, first week of every month, the governing body or those charged with governance should get an understanding of what is the status of audit, how much extent they have completed, and how much more time they will try to get to close the audit. Okay, now other matters that are relevant to timely communication will involve, so how big is the organization, so what is the size, and what is the operating structure, and what is the legal structure, control environment in which it operates. All those things will come into play. So, and then the second point is important. What is the legal obligation for the auditor to communicate? Now, so I have one question, okay, but I don't know. So I know that I could not get a response in this mode, but so whether there is any legal obligation for us to communicate these matters within a specific time frame. Okay, so these, see, there is no, so for example, that's what I said. No, so we have seen this is as soon as practicable. As soon as practicable, I don't know, so it is immediate in nature. You cannot take 2 days, 3 days time to conclude this. Okay, so what are the, so third thing is very important. What is the expectation of the management? Like you just communicated, whether first week of every month we can meet to discuss what is the status, arrangement made, other things. Fine. So these are some of the way in which communications can take place. Okay, timing. The timing is very simple. It is as soon as practicable. Okay. Now, so planned audit procedures you should communicate at the beginning of the period when there are significant issues that may lead, that is likely to lead to a modification of opinion. You have to communicate as quickly as possible. Yeah. Now, so what is adequacy? What is considered as adequate? Okay. So there is no, so the auditor is not expected to design the specific audit procedures to support the evaluation of two-way communication. Okay, the objective is not that, but the objective is that evaluation may be based on observation resulting from audit procedures. Okay, such observations may include appropriateness and timeliness of actions taken by those charged with governance in response to matters raised by the auditor. Okay, and the willingness and the capacity of the auditor, those to meet the auditor without management presence, the apparent ability. See, adequacy. These matters are very procedural in nature. Okay, so don't think that, okay, so how procedural nature. This all has been documented in the form of a standard on auditing. So how, so these things will lead to. So as far as an audit is concerned, kindly bear in mind that if you don't meet these people, okay, if you don't meet the governing body, and you say at the time of audit preparation of audit report or releasing the audit report that you have concluded that this is a qualification matter, okay, then now what will happen? Okay, the point is there might be a bad example of not discussing and not communicating, so that the management or those charged with governance could have given a better responses or some evidences for us to have a better audit evidence. Okay, so to avoid these things, okay, these are some of the procedures which is repetitive in nature and very practically practical in nature, to be performed by the auditor. Okay, now I'm not sure if we are clear at the time of questioning or response, then I will be able to understand. Now let us move on to documentation. Here again, documentation is very simple. So whenever there is a meeting, wherever there's a meeting, the auditor is expected to build documentation in support of those procedures. Okay, if there is only an oral communication, the auditor is supposed to prepare minutes, and then he has to retain that as part of his audit documentation. Clear? Okay. So documentation in each of the standards we have seen in 250 also. We have seen this looks very simple, but this is very important. Without this, I don't see any standard here. Okay. So this has to be maintained by the audit. Okay. Now let us move on to the next standard, standard 265. So 265 might appear to be a subset of 260. Okay, so this 265 is deficient. It is about communication of deficiencies in internal control. 260 is communication of all significant matters. Okay, independence, planned audit procedure. 260 includes 265. Okay, but because this is having a specific handling a specific issue, it is having a set of guidance for these specific matters. Okay, now so this standard is applicable standard this auditor how to communicate management deficiencies relating to internal control. Okay, now so what are the objectives? The objective is to communicate to those charged with governance and management deficiencies in internal control. Okay, so if you have identified any deficiency in internal control, you as a statutory auditor will report, will communicate. It is not report, it is communicating. You are communicating to the management of those charged with governance. Okay, now the definitions. So definitions of deficiency in internal control, significant deficiency. Deficiency exists when a control is designed, implemented in such or operated in such a way that it is unable to prevent or detect or correct misstatements in the financial statements on a timely basis. Okay, there is a control. It is not able to prevent or detect or correct misstatements. Then it is a deficiency. Okay, there is a second control. When there is a control which is necessary to prevent is missing. Okay, these two cases there is a deficiency. So deficiency means a control is not able to prevent or detect material misstatements, for example. Okay, there is no control to prevent misstatements. So this is something which is missing. The above is there is something which is inadequate internal control. Okay, what is a significant deficiency? Significant deficiency is nothing but a deficiency which is identified above, okay, or a combination of deficiencies in the professional judgment of the auditor, okay, is of sufficient importance to merit the attendance of those charged with governance. Okay, right. So what is that? What is that is meriting the attention of those charged with governance? Those charged with governance that the auditor might think that there is a material misstatement which has actually occurred, or there is also likelihood that the material misstatement could occur, and the potential magnitude of misstatement might be very high. Okay, significant deficiencies is something which may exist even before the auditor has identified misstatements. Okay, so deficiencies is a deficiency where there is no control, or where there is a control which is insufficient. Okay, significant deficiency is something which merits attention of those charged with governance. That's about it. Fine. So how to identify? Okay, so identify. Okay, whether the auditor has audited may discuss a relevant fact. Okay, fine. So what has happened? First, the auditor is observing that there is a deficiency, and the auditor may discuss these facts and circumstances of the findings with the appropriate level of management. Right? So appropriate level of management is again, so it's a subset of management, or management if it is a smaller organization. Okay, so why this has to be discussed with them? So this has to be discussed with them so that they get an opportunity to alert the management on a timely basis to understand that there is an existence of deficiencies, so that which means that the organization is not previously aware of those things. Okay, the level of management with whom it is appropriate to discuss is one that is familiar with the internal control area concerned. For example, okay, so what is this that we have discussed so far is different from the previous standard which we have discussed. Okay, previous standard has limited its discussion only to management or those charged with governance. Here it says appropriate level of management. Suppose, okay, the understanding for you friends is to understand the appropriate level of management. For example, there is a marketing, there is a sales order. Okay, suppose the discounts are being given, higher discounts are being given by a sales manager, not being monitored. There is an issue. So first, the most important point is this has to be discussed with the sales and marketing team, or the head of sales and marketing team, and then the management, and then those charged with governance. Okay, so this is why so it starts with the subset, the lower set of management. Okay, so that's why the standard saying the level of management with whom it is appropriate to discuss is the one who's familiar with the internal control area concerned, and that level of management should have the authority to take remedial action on the identified deficiency. Okay, in some cases, okay, it may not be appropriate for the auditor to discuss the audit findings directly with the management if the findings appear to call management integrity. Okay, there are chances that you may not be able to discuss with the management itself because of the integrity issues. Okay, integrity or competence issue. How will you discuss with them? So you may not discuss with them. You will discuss those charged with the governance. Fine. Okay. So I hope that I have explained as to what is the level of management, and what is the management, and what is those charged with governance. Okay. In discussing these facts and circumstances, okay, the auditor may obtain relevant information, additional information for further consideration. So what are those? So management understanding. What is the management understanding? Okay, so auditor has performed procedures from his perspective. So against the management should have the defense. Now, what is the management defense? That is their understanding. Now, exceptions whether the management may have noted. Okay, and then preliminary indication from management of its response. Right. So what is their understanding? Have they identified something, or whether there is any indication? Now, in a smaller organization, if there is a control activity, then the format is very simpler. You will just report that to the management or the sole management. So those activities are very small in smaller entities. You need not report to the appropriate level of management. You will report to the management itself in case of smaller entities. Okay. Now, identified. So the first one is identification. Second one is identified. Suppose auditor is identified. significant deficiency, which is shortly written as ST. If the auditor has identified significant one or more deficiencies in the internal control, he shall determine on the basis of audit work performed, whether individually or in combination, they shall constitute significant deficiencies. Okay. Now it is a responsibility. So there may be a lot of deficiencies, and individually, if all those deficiencies do not constitute significant deficiencies, then it is okay. If it is not okay, if all those deficiencies add up and they might have they might be constituting significant deficiencies, what should be done? We shall determine. Okay. Okay, fine. So examples of those matters will give you a lot of guidance. So it says likelihood of deficiencies, which may lead to material misstatements in future. So it will be a significant deficiency. Susceptibility to loss or fraud to related asset or liability. Naturally, it becomes significant deficiency. Okay. Subjectivity and complexity of determining estimated amounts, fair value amounts, possible. Significant deficiency. Okay. So fair value is always a matter of question, but I'm not sure why. So if it is complex, they're saying it is significant deficiency. Okay. So, for example, interaction frequency, interaction of deficiency with other deficiencies in internal control. So some controls, if it is failure, then it might have impact on other set of internal controls. Okay. And then the quantum of activity which has occurred. Okay. So that these things might be called a significant deficiency based on the quality or the quantum of failure which might arise in future or present. Okay, will result in identification for significant deficiency. Number one. Number two. Okay, fine. So indicators of significant internal control include again. So absence of risk assessment procedure, evidence of ineffective entity risk assessment procedure, evidence of ineffective response to identify significant risk. So which means that auditor has communicated the significant risk to the management. Management has taken no action on those significant risks. Okay. So the company is having an internal control, but it has failed to detect misstatements. Okay. Prior paid items, presence of prior paid as items in P&L. Okay. So these are indicators that the management internal control system is not able to detect, prevent deficiencies. Okay. Now, the organization would have implemented controls whether individually or in combination to prevent misstatement, but the deficiencies may have arisen for many reasons. Okay. So individual. So, for example, that's what he's saying. When individual, it may not be sufficiently important to constitute significant deficiencies, but as a combination, some of these things might lead to significant deficiency. Okay. So this provides an example, okay, of what will become a significant indicators. Okay. So what about will become significant deficiency? Okay. So what will happen? The auditor is required, as per this paragraph 9, to communicate in writing to those charges components of all the significant deficiencies on a timely basis. Okay. So communicating significant deficiencies in writing reflects the importance of these matters, right? And it will assist those charge and governments to fulfill their oversight responsibilities. Okay. So in determining when to communicate on communication, the auditor may consider the receipt of such information would be an important factor in enabling TCW, those charged with governance, to discharge their oversight responsibilities. Okay. So what is their oversight responsibilities? Oversight responsibility nothing but, okay, those charged with governance will ensure that the internal control will operate effectively. Okay, that is the oversight responsibility. Okay, which means that they will direct the management to take corrective action so that they will ensure that significant deficiencies will not arise in future. Simple. Okay. Now, regardless of the timing of significant return communication of significant deficiency, the auditor may also communicate these things orally in the first instance. Okay, and these things will ensure the management or those charged with governance to take appropriate remedial action to minimize the risk of material mistake. Okay, so understand difference between the previous and this standard. This standard is confining itself into minimizing or reducing the risk of material misstatements. Okay, fine. So timely communication will be important for reducing the risk of material misstatement. Now what is the level? Okay, what is the level of detail in which this has to be reported? This depends. So this will definitely depend on the nature of entity, size and complexity of the entity, the nature of significant deficiencies. So what is the entity's governance composition, legal regulatory framework? Okay, so the level of detail will depend on these 5 factors. Okay, so management and those on the governing body may also be aware of the significant deficiencies that the auditor has identified. Okay, and they may have concluded that they will not do any action, or they did not do anything to remedy because of the cost and other consideration. Okay, so which means that it is the responsibility of the management to evaluate the cost and benefit and implement the remedial action, right? So regardless, accordingly, so the requirement of paragraph 9, so it's this communication significant deficiencies, regardless of may consider relevant to the remedy. Okay, fine. So this means that, okay, so management has been aware of some deficiencies. They may have decided not to act because of cost and benefit of those considerations. Okay, in this case, so what would happen? So the auditor has communicated. So there's a second scenario. The auditor has communicated a significant deficiency to those charged with governance, and in a previous instance, does not mean that auditor will not communicate in the current period. For example, there is a significant deficiency in the last year, in the current year. Okay, so last year we have communicated, but does that mean that the auditor is not required to communicate in the current year? The answer is no. The auditor has to communicate every time until the significant deficiencies are identified. Only when it is resolved or remediated, he will be in a position to eliminate from his communication. Okay, until so if previously communicated deficiency remains, the current year communication may repeat the description from the previous communication. Okay, so it is not that. So the point is, the remediation has not taken place, that itself is a deficiency. Okay, the remedy, they have to action and eliminate the significant difference. If there is no action, the significant difference will continue. That's all. Okay, so now fine. So this says significant deficiency should also be communicated to the management. Okay, so here this is what we discussed. Ordinarily, the appropriate level of management is the one who has the responsibility and authority to evaluate the significant deficiency, to evaluate the deficiencies in the internal control and to take necessary action. Correct? So the communication means communication should be made to those charged with governance, and now the communication should be made to the appropriate level of management. Okay, so okay, fine. So certain, for example, there are certain identified significant deficiencies, and we may call question integrity. Okay, so for example, the auditor has identified significant deficiencies, which will raise huge questions on the integrity and competence of the management. Okay, so how will you identify that? Suppose there is evidence of fraud. Now the management inabilities to oversee the preparation of adequate financial statements. Okay, so it is not appropriate in this scenario to communicate such deficiency directly to the management. So as we discussed in last 1 or 2 standards, You will not discuss these with management. If there is integrity issues or competency related issues relating to management, you will not discuss with management. You will discuss directly with those charged with governance. It is like making a complaint. It is like making a statement that somebody is not competent to work, competent to be a manager, competent to be a CFO, competent to be a CEO. Okay, that you will not tell him on his face. That you will tell his higher authority, which is nothing but those charged with governance. Okay. No. So the comment, so here again there is a repetition. So the management's the communication with the management need not always be in writing. It may be in oral. Okay, where the auditor has discussed the facts and circumstances with the management, the auditor may consider oral communication of other deficiencies at the time of these discussions. Okay, the formal communication need not be made subsequently. Okay, this is at the level of communicating to the appropriate level of management. Now, okay, again, so this is something which is repetitive with respect to those charged with governance. This is something which is management. So if we had communicated something in the past, we will continue to report to the level of management until the deficiency is cleared by them. Okay. Now, okay. So what is the content of the this is nothing but the content. What should be the content of the return communication? Return communication should have two things. One, a description of deficiency and sufficient information, the major heads, major bullet points, the sufficient information to enable the governing body or the management to understand the context of the communication. Okay. In particular, the auditor shall explain the purpose of audit. The purpose was for forming and expressing an opinion, and the audit included consideration of internal control relevant to preparation of financial statements. Okay, so this is anyway we are reporting this separately as part of company audits. Okay, so all the significant deficiencies are communicated as part of the guidance on internal control relating to over the financial reporting. Fine. The key consideration is in explaining the potential effect of significant deficiencies, auditor need not quantify those effects. So this is the major difference. So when you have a non-compliance of non-regulations, the financial consequences should be ascertained. But here, potential effects of significant deficiencies need not be quantified. Okay, so as the standard says, what is significant deficiency? Something that require attention of those charged with governance. Okay, please have that in mind. The significant deficiencies may be grouped together for reporting purposes where it is appropriate to do so. Okay, fine. So auditor may consider appropriate to include the following information. Okay, what are the indication that if the auditor had communicated, auditor had performed more extensive procedures on internal control, the auditor might have identified more deficiencies to be reported. Okay, and indication that such communication has been provided for the purposes of those charged with governance, and it may not be suitable for any other purpose. So these are standard set of wordings which will include as part of the report. Okay, so the kind of audit related statements. Right. Okay, so this standard will also have documentation. The documentation we have not specifically put. Okay, so I think this is the end of the session. Can we have questions, please? So can I have questions? Sorry, I have only one question in the screen. Yeah, so there is a question from Jerome. So I think she's asked. So what is the difference between TCW, appropriate level of management, and management? Okay, so I'll give you an example. Appropriate level of management is a marketing head. Okay, management is board. Those charged with governance may be board of parent company. Okay. Okay. Any questions, sir? Sorry.
One minute, sir. There's another question, sir. You can see.
Yeah, there is another question.
You want me to? Yes.
No problem. I'll read out, sir. So there is a second question that so how to document oral communication. So okay, fine. So oral communications, you can have minutes of the meetings with those respective individuals. So that is how you will maintain documentation for oral communication. Okay. So for example, I'll tell you best example of oral communication is inquiries with management, inquiries with marketing head, inquiries with finance team, inquiry with the CFO. All those are oral communication. So what we used to generally do is that we create minutes of those meetings, okay, and share between us and agree, so that they will say, they will acknowledge that yes, this is what we discussed, and so on, so right. So this is general and best way to have oral communication. Clear? Yes, sir. If the auditors have concerns on IFC, yes. Auditors have concerns on IFC, which means that you are saying you will there is no internal control. Okay, so I assume that the question says that if there is concerns, okay, if there is concern, that means that there is no internal control in respect of financial reporting. Then what will happen is naturally it may lead to qualification also, sir. 100%. So I don't use this. Yes. Any other questions, please?
All the questions are answered, sir. No.
Okay. Yes, sir.
Sir, SKG, sir, over to you, sir, for vote of thanks, sir. We have completed most questions. We're done with the session.
Selva sir, any more questions, please?
No, sir. Those were the questions, sir. You can continue, please.
Okay. Thank you, sir. First of all, I would like to thank Jagdishan sir for giving a wonderful insight on SA 250, 260, and 265 and the relevant and the need of communication and our importance in making the documentations of all the audit findings or wherever classes like in 260, 60 and 65. He has given us in detail how the significant requirement of the communication, which is very, very vital and which is going to be the almost all the need of the hour as a back paper for the entire control of what activities we have been doing or what we have did and how we have communicated the observations, either it is to the management or to the TCWG. So I think it was a wonderful session which have highlighted, and from the takeaway is that the documentation and the communication of our internal audit observation or the deficiency or the control things has to be documented and kept across for our future reference. The takeaway of this session, it was a wonderful session, sir. On behalf of SARC, I would like to again thank you, Jagdishan sir, for making this event a grand thing. And I thank one and all present, and everyone will be assured of saying that the documentation is the important of the day. Thank you, sir.
Thank you so much, sir. Thank you so much for giving the wonderful opportunity to speak to the members. I thank you for your time and introduction. Thank you so much, sir. Thank you, members, for participating and understanding the requirements. Thank you very much.
Thank you, sir. Proceed.
Thank you.